All right, let's jump right into this deep dive. We're looking at the Colorado commercial real estate market for November 2025. And the theme is, well, it's extreme bifurcation.
Yeah, that's the perfect word for it. It's a market of massive winners and some really big losers all at the same time.
And it's all being driven by one huge constraint.
Yeah.
The highest capital costs we've seen in a decade.
Exactly. That high financing cost is the single biggest story. High interest rate coupons they've functionally just halted large institutional investment.
So the big money is setting out.
For the most part, yeah. Transaction volume is way below the 10-year average. What we are seeing is smaller deals, under $5 million.
And who's funding those?
It's mostly private capital. All cash deals or people using what's called a 1031 exchange to roll gains from one property into another without paying immediate tax.
Okay, so with credit so tight, what's the big ripple effect we should be watching?
It's hitting the supply side first and hard. New construction starts for both multifamily and industrial are just falling off a cliff.
And that slowdown is what's setting the stage for what comes next. It actually improves the visibility for net operating income, the NOI, as we head into 2026.
Absolutely. So let's talk about the losers first. It's no surprise, but the office sector's structural decline is just getting deeper.
The numbers are pretty staggering.
They are. The Denver metro vacancy rate hit a record high of 17.9% in the third quarter. That's painful.
And this isn't just a cyclical dip, right? You're saying this is a real structural problem.
It is. Older assets face massive risks. The only way you'd even touch them is for a specialized conversion or if you're getting them at just a rock bottom discount.
But on the flip side of that, we have some resilient anchors.
We do. Industrial and retail are holding up surprisingly well. Their fundamentals are still very strong.
And retail, which everyone kind of wrote off for a while, is actually benefiting from consumers focusing on necessities, right?
Yeah, that's a great point. Our sources show Colorado's retail absorption was consistently positive all year. It's a sign of healthy, stable demand.
Okay, but even within industrial, which has been the darling, you flagged a very specific localized risk.
Right. We have to talk about Northern Colorado. On the surface, it looks great. Vacancy is tight, around 3.9%, but there's a huge wild card.
The new Amazon facility.
The 3.87 million square foot Amazon logistics facility. It's massive.
Right, 3.87 million square feet. So if that one building delivers and, let's say, it doesn't get absorbed quickly.
You see the risk. That one asset could theoretically cause the entire regional vacancy rate to spike to over, say, 13 or 14%, literally overnight.
Wow. That is a huge concentrated risk.
It's low probability, but very high impact. It's why smart money is being extra careful in that northern corridor.
Okay, let's pivot to the sector that's seeing peak pain right now, but might be setting up for the biggest future gain. Multifamily.
This is the one experiencing the sharpest correction, and it's almost entirely because of that historic wave of new units hitting the market.
The pain is real. The data from Q3 showed year-over-year rents were down.
Yeah.
What was it?
A very harsh negative 7.2%. And Q3 was the first quarter we saw negative net absorption since late 2022. It is a very tough environment for current owners.
But that pain, that volatility, is what creates the opportunity. This is a classic counter-cyclical play.
Because that supply shock is ending just as quickly as it started. New construction completions dropped a staggering 62.8% year over year.
So the market is getting very close to its cyclical bottom.
We think so. If you're looking to buy, the window is basically now. Q4 of 2025 looks like the optimal time to go after those Class B and C assets, workforce housing.
So why now specifically? Why not wait for Q1 of 2026? Isn't there a chance prices could fall a little more?
There is. You're always trying to catch a falling knife, but if you wait too long, you risk missing the turn. By mid-2026, we expect that supply shortage to really start pushing up rents and tightening vacancies.
So this is about buying ahead of the curve while the market is still pessimistic.
Exactly. So to boil it all down for 2026, we're really looking at two main strategies.
Okay, what are they?
First, that counter-cyclical multifamily buy, targeting B and C assets, ideally this quarter. And second, just using the stability of industrial and retail as defensive anchors in a portfolio.
And before we go, we have to talk about the largest systemic risk you identified in the reports. The big one to watch.
Yeah, the elephant in the room. It's the impending wave of legacy debt refinancing.
Specifically for office properties, right?
Particularly for those non-institutional office properties. You have owners who took on really cheap debt years ago, and now they're facing these huge interest rate resets they can't afford. That debt wall is the single biggest threat to lender stability.
And if that forces a wave of sales, it triggers what the pros call price discovery, which is just a fancy way of saying we all find out how much less these buildings are actually worth.
Right, and that could create some real contagion. It's definitely something for you to keep a close eye on as we head into the new year.